Now, it's been 60 years since communist rule began in China, and most now agree that China has become a key engine for global growth. So how will China's growth priorities impact the rest of the world? Let's turn now to one of the Beltway's top China watchers. He's Nick Lardy, economist and senior fellow at the Peterson Institute for International Economics, and he comes to us from Washington, D.C. Hello, sir. Thank you for joining us. BRIC economies are set to lead growth next year, with China as the standout. What has China done right in the past year as a credit crisis raged in developed markets?
Well, they had a very strong policy response. Monetary easing got started early, more than a year ago, and given the strong position of the banks in financial terms, they were able to increase lending very dramatically over the last 7 or 8, 9 months, and that has fueled a very, very powerful recovery.
Now, just as in the U.S., government stimulus certainly the driving force there in China. What specific policies is Beijing putting in place here to boost domestic demand? Because that's the one area that everyone says needs to get better.
Well, they've done a lot of things. They've cut taxes on automobile purchases, for example, if they meet certain requirements. They've lowered prices of some flat goods, durables purchased by households. They've dramatically increased their support for education, health, and so forth, other social programs over the last 2 years to try to give people more confidence that these services will be provided by government and they don't need to save to self-finance them. So we're seeing very, very strong consumption growth, way over 9.5% in the second quarter of this year. So consumption is making a very substantial contribution to the expansion of the economy.
China has also told its banks to open up the spigots and make more loans. What about the unintended effects of that? Perhaps the threat of more bad loans as these banks make credit more widely available?
Well, of course, there is that risk whenever you have a big boom in credit, as China has had. But the good news is that not very much of this credit is going to the manufacturing sector. It's mostly going to infrastructure that is associated with their very strong urbanization. They're building a lot more subway systems, for example, water treatment systems, intercity rail, power grid. All of these are areas, I think, that will have relatively high rates of real economic returns. So I think the NPL problem will be manageable.
And is that how China grows consumption without generating stock market and real estate bubbles? Because a lot of the times that's where consumers, people, are putting their money.
Well, we've seen a significant correction in the Shanghai market over the last month, a 20% correction. It'll probably go back up again. But property market is recovering gradually, so we're seeing a lot of private investment going into property after a correction of almost a year and a half. And other kinds of consumption are also growing. So a number of policies are stimulating. As I mentioned, the credit side, the price side have contributed to the resurgence of China's economic growth.
Now, China is the biggest holder of U.S. Treasuries. We know that. How much do you see the government cutting back or limiting its purchases of U.S. debt with its exports declining?
Well, their external surpluses are falling quite dramatically now. I think they will be about half. This year in 2009 will be about half the level of 2007. So their purchases of U.S. Treasuries and other U.S. dollar-denominated financial assets are likely to come down. Of course, there are transactions on the capital account. They have had hot money inflows, for example, earlier this year that contributed to the need to substantially increase their purchases. But the trade surplus, which has been the big, big driver of China's buildup of foreign exchange reserves, has now begun to fall quite dramatically.
And Nick, with China, you always have to be somewhat suspicious of the economic figures. The numbers can basically be whatever the government wants it to be. How do you reconcile that with the expectations placed on China to pull the world out of recession?
Well, I think a lot of the numbers China puts out are very accurate. Their financial data, I think, is highly accurate. Some of the data are not worth very much. But if you're selective in your interpretation, I think you don't get too much misled. China is the first to recover globally. They began their powerful recovery in the first quarter, accelerated further in the second quarter. But keep in mind, China's less than 10% of global GDP, so it cannot really drive the whole global economy. It can have a substantial effect on commodity prices in certain areas. And, of course, it's a net plus for the global economy that they're growing rapidly. But we're going to have to see some recovery in the U.S., Europe, and Japan before we really see strong global growth. China can't lever up the whole world with only 10% of global output.
Right, China can't do it on its own. Thanks so much. We've been speaking with Nick Lardy. He is Senior Fellow at the Peterson Institute for International Economics. He was joining us from Washington, D.C.